All right, so let's talk about a big moment in any partnership. A partner decides to retire. This is a huge deal, and it kicks off this whole super important financial process. The big goal here is pretty simple. Figure out exactly what that partner is owed, make sure the split is clean and fair, and of course, keep the business running smoothly. So let's jump right in.
Okay, so we're going to break this whole thing down into 5 easy-to-follow steps. First, we'll cover what a retirement actually kicks off. Then, we'll dig into this thing called the gaining ratio. After that, we'll talk about revaluing the company's assets, squaring up all the books, and finally, how does the partner actually get their money? Think of it as our roadmap for the next few minutes.
All right, first up, the shakeup. So, a partner is leaving. And this is way more than just a handshake and a goodbye cake. It's a huge shift, a real fundamental change to how the business is structured.
And that brings us to the million-dollar question, right? What happens to their share? Our job is to nail down the exact fair value of their piece of the pie on the very day they leave. The whole point is to make sure they get paid what they're owed, but in a way that doesn't, sink the ship.
So where do we even start? Well, funny enough, before we can figure out what the retiring partner gets, we have to look at the people staying behind. We've got to decide how they're going to share profits from now on. It really is all about reslicing that pie.
And that leads us to a really important term, the gaining ratio. It sounds technical, but it's not. Just imagine 3 of you are sharing a pizza. One person gets up and leaves, but their slice is still there. The gaining ratio is just how did the 2 of you who are left split that extra slice? That's it. It's the proportion in which you gain the share of the person who left.
Okay, let's make this super concrete with an example we'll follow all the way through. So say you've got 3 partners, A, B, and C. Their profit share is 50%, 30%, and 20%. Now, partner B decides it's time to retire. A and C get together and agree on a new split, just between the 2 of them, 60-40. Now, you can clearly see their shares went up, right? But the real question is, by how much exactly did each one gain?
And the math here is actually, believe it or not, really simple. All you do is take their new ratio and subtract their old ratio. So for partner A, they gained 1/10 of the total profit share. For partner C, they gained 2/10. So what's our gaining ratio? It's 1:2. That tells us that C is picking up twice as much of B's old share as A is. See? Simple.
All right, moving on. Step 3 is all about getting real with the company's value. You know those numbers you have on the books, the book value? Chances are they don't really match what your stuff is worth today. A partner leaving is basically the perfect excuse to do a full-on reality check and update everything.
But why now? Why this specific moment? Honestly, it boils down to one word: fairness. Think about it. Maybe the firm owns a building that has secretly doubled in value over the last 10 years. Or maybe that shiny new machine is now worth way less than you thought. The retiring partner was there for all of that. They were part of the team when those values changed, so they absolutely deserve their cut of that hidden profit. Or they have to take the hit for any loss. Revaluation makes sure their payout is based on what things are worth now, not what they were worth years ago.
Let's look at a quick example. Say you have some machinery on the books for $20,000, but it's really only worth $18,500 today. That's a $1,500 loss right there. And the inventory, listed at $16,000, turns out it's only worth $13,600. So when you add it all up, this revaluation process has uncovered a total loss of $3,900.
Now here is the absolute key takeaway. That $3,900 loss, it's not just a problem for the partners who are staying. Nope, it gets shared by everyone, including the retiring partner based on their old profit-sharing ratio. And that's because, well, that loss in value happened on their watch, while they were all still a team.
Okay, so we've got our new profit ratio, and we have the updated real-world value of our assets. Now it's time for the main event, squaring up the books. This is where we pull everything together to figure out that one final all-important number, exactly what is owed to the partner who's leaving.
This final calculation is basically a 4-step recipe. Step 1, you start with what they already have in their capital account. Step 2, you add their share of any saved-up profits, the reserves. Step 3, you add their piece of the company's goodwill. That's the value of its good name, its reputation. And last, step 4, you add or subtract their share of that revaluation profit or loss we just talked about. And voila! The number you're left with is the final payout. All right, the math is done. Everyone's agreed on the final amount. So we're at the finish line, the final payment. How does the partner actually get their money?
Now, you'd think they just cut a massive check, right? But that almost never happens. I mean, think about it. Paying out a huge lump sum of cash could seriously cripple the business. So, thankfully, there are other ways to handle it, like turning it into a loan or paying it off over time.
And the most common way by far is to move that final amount into what's called a retiring partner's loan account. It's pretty clever, actually. The retiring partner basically becomes a bank, lending that money back to their old company. The business then pays them back over time with interest. It's a real win-win. The partner gets every penny they're owed, and the business doesn't have a cash flow crisis.
So let's zoom out. Why is all this so important? Why follow these 5 steps? Well, it's about making sure the person leaving gets a fair deal while protecting the business they helped build. It creates a clear, drama-free process that stops arguments before they can even start. And really, what it all points to is just how incredibly vital it is to have a rock-solid partnership agreement in place from the very beginning. And that brings me to my last point. You can know all the accounting steps in the world, but is your partnership agreement ready for this moment? Because having a legal document that lays all this out before anyone talks about leaving, well, that's the difference between a messy breakup and a smooth professional transition. So is yours ready?